Finance. The study of managing and allocating funds at the personal or business level. Accounting. The system of recording, reporting, and summarizing past financial information and transactions. Capital. A financial asset that can be used by a firm or individual. Examples of capital may be machinery or cash held by a firm. Subspecialties of finance. 1. Business finance. 2. Investments. 3. Financial institutions. Business finance. An area of finance that deals with sources of funding, the capital structure of corporations, the actions that managers take to increase the value of the firm to its owners, and the tools and analysis used to allocate financial resources. Capital structure. The mixture of debt and equity used to finance a firm. Investments. An area of finance that involves deciding which assets to invest in to create wealth in the future. Asset pricing. The process of valuing assets. Current market value. What someone would pay right now for an asset. Financial institutions. An area of finance that includes firms or organizations that exist to accept a wide variety of deposits, to offer investment products to individuals and businesses, to provide loans, or to broker financial transactions. Utility. The total satisfaction received from consuming goods and services. Publicly traded firm. Firms that have issued shares to the public. Privately held company. Firms that have not issued shares to the public where the ownership rights are privately held. What are 3 main tasks of a financial manager? 1. Making investment decisions. 2. Making financing decisions. 3. Managing working capital. Research and development. The business function responsible for improving and developing services and products. Cash management. Managing the day-to-day finance operations of a firm. Tax strategies. Methods used to minimize the amount of taxes a business pays. Financial policy implementation. Incorporating new finance ideas within a firm. Venture capitalists. Professional managers of investment capital that typically invest in very young new ventures. Harvest. Generating cash or stock from the sales or IPO of companies in the portfolio of investments. Teller. An entry-level commercial bank position with the responsibility to interact with customers at the bank's front desk or drive-through window. Credit analyst. A commercial bank position with the responsibility to assess the riskiness of lending to borrowers and determining whether or not loans should be extended to potential bank clients. Personal banker. A commercial bank position with the responsibility to find and attract new clients. Trusts. An arrangement that allows a third party to hold assets on behalf of a beneficiary or beneficiaries. Estates. Everything that a person owns or controls, especially at death. Wills. A legal expression of an individual's wishes concerning the deposition of his or her property after death. Liquidity. The ability to turn financial securities into cash easily without losing significant value. Treasury securities. A debt instrument that is issued by the United States government in order to raise capital. Revenues. The top line of the income statement, the total amount of money a business brings in. Corporate bonds. A debt instrument that is issued by a corporation in order to raise capital. Stock. A share of ownership in a company. Money market. A type of financial market used for short-term assets that are held for less than 1 year. Capital market. A type of financial market used for long-term assets that are held for greater than 1 year. Primary market. The financial market where securities are first sold. Syndicate. A group of intermediaries that is used to oversee the issuance of stocks and/or bonds. What are the three main types of financial securities? 1. Treasury securities. 2. Corporate bonds. 3. Stocks. IPO. When a privately held company first offers shares of stock to outside investors to raise capital, therefore becoming a publicly owned company. Secondary market. The financial market where securities are traded after the initial issuance. Auction market. A secondary market with a physical location and where prices are determined by investors' willingness to pay. G. New York Stock Exchange. A physical trading floor in the computer network where stocks are bought and sold. It is the largest stock exchange in the world. Dealer market. A secondary market made up of multiple dealers that hold an inventory of securities and quote prices. Nasdaq. A computer network where stocks are bought and sold. It is the second largest stock exchange in the world. Typically, technology-related companies will go public through this exchange. Specialist. A market maker on the New York Stock Exchange that holds an inventory of securities and acts as a liquidity provider to those that wish to buy and sell. Risk. The possibility that the realized or actual return will differ from the expected return. Bid-ask spread. The difference between the bid and ask prices that compensate the specialist for the risk that he or she bears for willingness to provide liquidity. What are three roles of prices? 1. To convey information to consumers. 2. Prices affect incentives. 3. Prices affect the distribution of income. Efficient market. A market in which prices fully reflect all the available information about a specific security. SEC. An independent federal government agency that protects investors, maintains fair, orderly, and efficient markets, and facilitates capital formation. Central banks. Ensure that a nation's economy remains healthy by controlling the amount of money circulating in the economy. Banks and credit unions. Receive deposits and extend loans to individuals and businesses. Insurance companies. Charge premiums to invest in bonds and stocks to pay claims. Mutual funds. An investment company that continually offers investments and buys financial securities and instruments on behalf of investors. Pension funds. A financial institution that specializes in managing and administering retirement funds. Investment bank. A financial intermediary that offers complex financial transactions such as underwriting, facilitating mergers, and buying and selling financial securities on behalf of large institutions. Private equity. A financial institution that invests in an entity that is not publicly listed or traded using money received from institutional investors and wealthy individuals. What are two specific indicators of a leading indicator? Yield curve and stock market return. What are two specific indicators of a lagging indicator? Unemployment rate and CPI consumer price index. What are two specific indicators of a coincident indicator? GDP, gross domestic product, and person income. Ethics. Following accepted standards of moral conduct. Morals. Following one's standards of right and wrong behavior. Legal. Following the laws and rules set by an authority. Ethical dilemma. An issue in the process of deciding between multiple options where no option is completely acceptable from an ethical standpoint. Securitization. The process of combining several types of contractual debt and reselling them as a package to investors. Financial managers. A person who makes strategic financial decisions in a corporation. Shareholders. A person who owns shares of a company's stock. Bondholders. A person who loans a corporation money by buying debt securities. Agency costs. Costs that are incurred when management does not act in the best interest of shareholders. Agency problem. When the agent does not act in the best interest of the principal. Marketing. The business function responsible for generating sales. Sales. The top line of the income statement, the total amount of money a business brings in. Stakeholder. Anyone who may be affected by actions taken or a decision made. What is the main purpose of charging interest? It allows borrowers to pay to use the assets of another entity to accomplish their own goals. Interest rate. The percentage of the principal that a lender charges a borrower for the use of assets. APR. The annual interest rate that is charged for borrowing money or that is earned through investment. Discount rate. The name for interest rate when used in time value of money calculations. Cost of capital. The cost to a firm to use an investor's capital. See interest rate. Simple interest. The interest earned only on the principal. Calculated annual interest equals principal x interest rate x of periods. Compound interest. The interest on the principal plus the interest on earned interest. Calculate by total interest equals principal x number of periods principal. Required rate/rate of return. The minimum return or compensation an investor requires in order to invest. See interest rate. What are three components of required rate of return? 1. Opportunity cost. 2. Risk. 3. Inflation. Opportunity cost. The loss of potential gain from other alternatives when one alternative is chosen. Inflation. The rate at which the average price level of a basket of chosen goods and services in an economy increases over a period of time. What are three main sources of inflation? 1. Increased demand goods and services. 2. Rising costs. 3. Adaptive expectations. Risk-free rate. The rate of return on an investment with no risk. Risk premium. The compensation for the amount of risk taken on by investors. Nominal rate. The rate at which invested money grows for a certain period of time. Fisher effect. An economic theory developed by Irving Fisher holding that the real interest rate is equivalent to the nominal interest rate minus the expected inflation rate. TVM. The idea that money that is available at the present time is worth more than the same amount in the future. Present value. The idea that money that is available at the present time is worth more than the same amount in the future. Future value. The worth of cash flows in terms of the dollar amount in the relative future. Compounding. Finding a future value given a present value. Discounting. Finding a present value given a future value. Annuity. A stream of cash flows of an equal amount paid every consecutive period. Ordinary annuity. A series of equal payments made at the end of consecutive periods over a fixed length of time. Annuity due. A series of equal payments made at the beginning of consecutive periods. Perpetuity. A constant stream of identical cash flows that continues forever. Return. The money gained or lost on an investment over a certain period of time. HPR. The return over the entire period that an investor owns a financial security. Calculation is divided by bag price. Expected return. A hypothesized estimate of future prices or returns under different scenarios based on expectational data. Standard deviation. A measure of dispersion of possible outcomes about the mean. Market risk. Risk that is inherent in the economy as a whole and cannot be diversified away, also called systematic risk or non-diversifiable risk. Non-diversifiable risk. Risk that is inherent in the economy as a whole and cannot be diversified away, also called market risk or systematic risk. Systematic risk. Risk that is inherent in the economy as a whole and cannot be diversified away, also called market risk or non-diversifiable risk. Firm-specific risk. Risk that results from factors at a particular firm and can be reduced through diversification, also called non-systematic risk or idiosyncratic risk. Non-systematic risk. Risk that results from factors at a particular firm and can be reduced through diversification, also called firm-specific risk or idiosyncratic risk. Idiosyncratic risk. Risk that results from factors at a particular firm and can be reduced through diversification, also called firm-specific risk or non-systematic risk. Interest rate risk. The probability that changes in interest rates will impact the value of a bond. Default risk. The probability of a loss resulting from a borrower's failure to repay a contractual obligation, also called credit risk. Price risk. The potential for the decline in the price of a financial security or an asset relative to the market. Risk reduction. A series of techniques that help reduce the amount of risk a person is exposed to by taking a particular action. Diversification. The process of spreading your money over many different assets. Correlation. The measure of the relationship between two variables that move in relation to each other. Risk separation. A risk management technique that involves dispersing assets geographically instead of concentrating them in one location. Risk transfer. A risk management technique that involves reducing the amount of risk you are exposed to by transferring that risk to another entity. Risk retention. A decision to take responsibility for a particular risk. Risk avoidance. A way to manage risk by not performing an activity that may carry risk. U.S. Treasuries. Bonds, bills, and notes issued by the U.S. government considered to be the highest quality securities available. Treasury note. A note issued by the U.S. government as a financial security with a fixed interest rate and a short maturity between 1 and 10 years, abbreviated T-note. Treasury bills. A bill issued by the U.S. government as a financial security with no interest and a maturity of less than 1 year, abbreviated T-bill. Benchmarking. The process of completing a financial analysis to compare a firm's financial performance to that of other similar firms. Trend analysis. Comparing a firm's ratios across time. Cross-sectional analysis. Comparing a firm's financial ratios to other firms' ratios or industry averages. Seasonal firms. Firms whose performance varies according to the season. Liquidity ratios. A category of ratios that measure a firm's ability to meet short-term obligations. Activity ratios. A category of ratios that measure how well a company uses its assets to generate sales or cash, showing the firm's operational efficiency and profitability. Leverage ratios. A category of ratios that consider how a firm is financed. Profitability ratios. A category of ratios that are commonly used to directly judge how well management is doing as they strive to maximize owner wealth. Market ratios. A category of ratios that are used to evaluate the current share price of a public firm's stock. Current ratio. A liquidity ratio found by current assets divided by current liabilities. Quick ratio. A liquidity ratio is found by current assets less inventory divided by current liabilities, also called the acid test ratio. Liquid asset. An asset that can be converted into cash quickly without the loss of significant value. Accounts receivable turnover. An activity ratio found by credit sales divided by accounts receivable. Average collection period. An activity ratio found by the number of days in a year divided by AR turnover. Inventory turnover. An activity ratio found by COGS divided by inventory. Total asset turnover. An activity ratio found by sales divided by total assets. Fixed asset turnover. An activity ratio found by sales divided by fixed assets. Operating income return on investment. An activity ratio found by operating income divided by total assets. List the liquidity ratios. 1. Current ratio. 2. Quick ratio. List the activity ratios. 1. AR turnover. 2. ACP. 3. Inventory turnover. 4. TAT. 5. FAT. 6. OPIO. Debt ratio. A financing ratio found by total liabilities divided by total assets. Debt-to-equity ratio. A financing ratio is found by total liabilities divided by total equity. Times interest earned. A financing ratio found by EBIT divided by interest expenses. List the leverage ratios. 1. Debt ratio. 2. Debt-to-equity ratio. 3. Times interest earned ratio. Return on assets. A profitability ratio found by net income divided by total assets. Return on equity. A profitability ratio found by net income divided by owner's equity. Gross margin. A profitability ratio found by gross profit divided by sales. Operating margin. A profitability ratio found by EBIT profit divided by sales. Net margin. The percentage of sales remaining after all costs have been deducted from a company's total sales, also known as net profit margin, indicates the profit earned by the firm. List the profitability ratios. 1. Return on assets ratio. 2. Return on equity ratio. 3. Gross margin. 4. Operating margin. 5. Net profit margin. Market to book. A market ratio found by market value of equity divided by book value of equity. Price to earnings. A market ratio found by price per share divided by earnings per share. List the market ratios. 1. Market to book ratio. 2. Price to earnings ratio. DuPont framework. An expanded formula of the return of equity net margin times total asset turnover times leverage multiplier, which represent the components of profitability, activity, and financing. Leverage. Another name for debt or liability. Financial risk. Increased volatility in earnings as a result of using debt. Cash budgets. A plan for controlling cash inflows and outflows business to balance income with expenditures. Fixed expenditures. An expense that you do not have direct control over and that remains constant from period to period. Variable expenditures. An expense that you have direct control over and that can change from period to period. Profit forecasting. The projection of future earnings after all projected costs are subtracted from projected sales. Balance sheet forecasting. Using sales growth and the profit forecast to construct a pro forma balance sheet to understand the future implications of the sources and uses of finances. DFN. The additional financing needed given the firm's expectations for future growth. EFN. Another name for the discretionary financing needed or additional funds needed. It represents the additional financing needed given the firm's expectations for future growth. AFN. Another name for the discretionary financing needed or external financing needed. It represents the additional financing needed given the firm's expectations for future growth. Spontaneous accounts. Accounts that vary naturally with sales. Discretionary accounts. Accounts that do not vary automatically with sales but are left to the discretion of management. Pro forma statements. A financial statement that projects an estimate for future periods as if sales grew is predicted. Net margin. The percentage of sales remaining after all costs have been deducted from a company's total sales, also known as net profit margin, indicates the profit earned by the firm. Retention ratio. The percent of net income retained in the firm, also called the plowback ratio. Plowback ratio. The percent of net income retained in the firm, also called the retention ratio. Payout ratio. The percent of net income distributed to the shareholders. Internal rate of return. The rate of return that a firm earns on its capital projects. Hurdle rate. The required rate of return that a company expects to earn in order to consider a project. Capital constrained environment. When a limited amount of funds are available. Mutually exclusive. When two or more events do not coincide. What are three methods for making investment decisions? 1. Net present value. 2. Internal rate of return. 3. Profitability index. Fixed income securities. Another name for bonds, a financial security in which the borrower pays a fixed interest payment to investors each year. Coupon rate / coupon yield. The stated interest rate of a bond. Par value / face value. The sum of money that a corporation promises to pay at the expiration of a bond. Bond indenture. A legal contract that governs the relationship between a firm and its bondholders. Yield to maturity. The rate of return that investors receive on a bond if they purchase a bond today at the market price and hold it until it matures. The required rate of return given the maturity and risk of the bond. Maturity date. The date at which a bond expires. Covenants. Statements in a bond indenture that outline things a company will obligate itself to do or not do in order to protect bondholders. Affirmative covenants. A bond covenant that describes things the company pledges itself to do in order to protect bondholders. Negative covenants. A bond covenant that describes things the company pledges itself not to do in order to protect bondholders. Default. Failure to meet a debt obligation. Premium bond. A bond whose price is above its par value. Par bond. A bond whose price is exactly equal to its par value. Discount bond. A bond whose price is below its par value. Market capitalization. The current market value of a publicly traded company's total outstanding shares indicating the size of a company. Common stock. A type of stock that represents equity in a firm and confers the right to vote at shareholder meetings. Board of Directors. A group of people who jointly supervise the activities of an organization. Corporate governance. The system of rules, practices, and processes by which a firm is directed and controlled. Upside potential. The unlimited earnings potential of equity ownership. Preferred stock. A hybrid security that has no fixed maturity, has fixed payments, and does not confer voting rights on bondholders. Hybrid security. A security that has some elements that resemble equity and others that resemble debt. Dividends in arrears. A feature of preferred stock specifying that if a company ignores preferred stock dividends, it cannot pay anything to its common stockholders. Cumulative. A feature of preferred stock specifying that if a company skips payment of a preferred stock dividend 1 year, it is still required to pay that dividend sometime in the future before paying any common dividends. Capital investment. The sum of money invested in a business to purchase long-term assets to further its objective of maximizing owner wealth. Intrinsic value. The value of an asset as determined through fundamental analysis without referring to the asset's market value. Perpetuity model. A formula used to value preferred stock that is based on the calculation of a perpetuity. Gordon growth model. A formula used to value common stock based on the assumptions that dividends are paid every year and grow at constant rate forever. Dividend discount model. A model used to evaluate common stock that calculates the value of a share of common stock today by taking the present value of future dividend cash flows. Beta. A variable that describes how the price of a security varies with the market. Aggressive assets. Companies or securities with beta greater than 1. Defensive assets. Companies or securities with beta less than 1. Capital asset pricing model. A model used to determine the risk-return relationship for an asset. Capital budgeting. The process of evaluation and planning for purchases of long-term assets. Incremental cash flows. Cash flows that result from accepting a project. Cannibalization. The reduction in sales of a company's own products due to introduction of another similar product. Sunk costs. A cost that has already been incurred and cannot be recovered.